Alright, what's up guys? I hope you're doing well. James here from jamesforesight.com, and I wanted to take a minute to talk about kind of the origins of the Federal Reserve in a way, more specifically kind of the historical and context in which the act was kind of produced, right? So how was society in general, how did they feel, and what were some of their thoughts about central banking before the Federal Reserve kind of came to be, right? And that whole kind of gestation period of the legislation, right? Because you really have to keep that in mind when you're looking at, I think, historical events in general, right? This all of this happens in context. It doesn't happen in a vacuum. So, and you kind of see that with how the Federal Reserve Act was kind of sold to the public in a way. We'll kind of get more in depth into that later in future videos as well. But my point is, you have to overlay the event on the actual historical context of the time, right? To really kind of understand the general dynamic in a way. And so with that being said, individualism in banking was kind of the way to go at the time. Everyone thought it was, banks were basically on their own. There was no centralization or major entity in general to do any form of, say, like concentration of reserves or whatever. So that's pretty much it. And so basically the fear was that if there was any sort of central entity that had any form of like regulatory control or like very explicit regulatory control or something along that nature, that it basically concentrate everything to either the government or Wall Street. And that was pretty much the whole concept of it. And so you'd have some form of political influence in banking in general, and it was kind of deemed that that was not wanted, right? And so basically you had this kind of fanatic conviction, right, of no centralized entities in banking, period, right? That sort of thing, to where it was very, very, it was thought of in a very negative connotation, right? And so basically everyone wanted complete decentralization in banking in general, and that was thought to be the way to go. But what was kind of deemed the problem of this, at least from the perspective of Mr. Paul Warburg, which is kind of what I'm using as a reference, because I think it's important to get that kind of point of view in there as well. And so it's really trying to see the same concept from pretty much every different point of view I can find, right? And so this is actually his book, Federal Reserve System, Its Origin and Growth. The first volume, it's like 800 something pages, and it can get very technical, but this is the one where it has the juxtaposition of the Aldrich Plan and the Federal Reserve Act. It's really cool. Anyways, and so basically his argument was, with this decentralization in banking, even within the restricted areas, meaning like it was banking was very localized, to where there was no like kind of system itself to reach across vast distances. It was very much on an individualized basis, to where you had, like, if there was settlement between a bank in North Carolina and Nevada or whatever, it basically just, like, you'd have to physically transfer the currency, and it was between those two banks and how they did everything or what it was doing and that kind of thing. It was very on an individual basis, right? And so even within the restricted areas, it was very ineffective in terms of the actual like settlement process, and especially dealing with reserves. And basically this led to grave, he says, financial convulsions, rather than prevent the occurrence of such calamities, right? Basically another panic of 1907, right, in a way. And so, not quite, without getting ahead of ourselves, I think it's important to kind of start talking about the National Banking Act beforehand, which I believe was passed in 1863 off the top of my head. It may have been 65, but that's neither here nor there. In the mid 1800s, right? And so basically, instead of doing a centralized like credit system, basically says the National Bank Act had been devised in order to create a uniform, though strictly decentralized credit system with a decentralized inelastic note issue secured by the deposit of collateral consisting of certain U.S. government bonds, right? And so basically you had individual reserves for the banks, and those reserves kind of limited the credit they could extend, kind of the whole idea of having like a hard reserve requirement to where they actually have to hold it in their vaults, sort of thing, and not just at like a reserve account like it is now with the Fed. And there's a lot that kind of goes in between the process of how that developed throughout time, right, which we'll get into later. And so basically you had different types of banks, right? There were different classes at this time, and this is one thing I didn't know about the National Banking Act. And it makes a lot more sense, and it also kind of parlays into the actual creation of the Federal Reserve System itself, to where you had different cities, right? Where you had country banks, and then you had reserve city banks, and then you had central reserve city banks. So it's kind of like three different classes, right? And each one, it was tiered to where it was central reserve was at the top, and then reserve, and then country. And then basically you had kind of a pyramided system of reserves. And this is where we get into the term of reserve agent. So basically what would happen was you'd have the country banks at the bottom, and they'd have to hold a small amount of reserves. And basically the amount of reserves that had to be held increased proportionately, meaning in percentage terms, for each kind of tier you went up that hierarchy, right? And so I think for country banks specifically, it was they had to 15% reserve on demand deposits, and then basically 6% had to be held in their own vaults, and then the rest could be held at another bank, which would have to be in like a reserve city, right? Going up the hierarchy, right? And so that bank that they're holding those reserves as demand deposits, right, is their reserve agent, right? And so basically, I think it's important to note that it's as demand deposits, because you have to distinguish between demand deposits and like bank reserves. They're different. Not so much at this time, but especially now when you're overlaying that and trying to compare systems, I think it's really important, because these are demand deposits, not bank reserves, right? Different liabilities in different places, right? Okay, and then basically you have the next tier up, you'd have the reserve city banks, and then they could use a reserve, and their reserve agent had to be a central reserve city. And the thing to note is that basically the classification depends on the city itself where the bank it is, not necessarily just the bank, right? And so like central reserve cities would be like New York, Chicago, and St. Louis, off the top of my head. And then regular reserve banks or whatever would be, or reserve cities I should say, is like New Orleans or something like that at this time, right? And keep in mind, this is the very beginning of the 20th century, right? So the dynamic of how and where populations were in the United States was quite different. But anyways, and so what was also cool was basically it was the National Banking Act, right? So that this basically just happened with national banks, right, who were chartered from the federal government, right? Whereas and at this time you had the state banks could also charter the state governments could also charter banks. And so basically you'd have the state government starting to copy the national plan, and you just kind of had, a national section and then a state section, to where they would do essentially the same thing with reserve agents and that kind of thing. And so you basically have national and state legislatures that combined in a way to create a system of basically pyramided reserves. And then basically he says this was bound to produce an artificial and unhealthy concentration of funds in the reserve and central reserve cities, and particularly in New York, right? He says New York specifically was because of the call loan market for the New York Stock Exchange, right? And basically said that that's the only reliable money reservoir where these reserve funds could be placed, right? And so that was really, or at least that seems to be the major argument for a lot of the little things and nuances in his kind of reasoning behind the centralization of reserves, right? Which was a big kind of selling point for the Federal Reserve Act. And so basically what he would say was, we want to take the reserves of the country's banking system, out of the call loan market for the stocks. And basically he wanted to do it on more commercial paper, right? And so he said that it would basically be more productive for the country. And at this time, kind of the commercial paper market wasn't as developed in the United States relative to other places, whereas in Europe this was significantly more developed. And so basically banks were already using it as kind of a almost more or less of a backing of the currency in a way. Not maybe not explicitly, but kind of like that's what they were using it for, right? And so it's something to kind of keep in mind, right? And so basically at this time, the only government bonds normally available were those that could be used as collateral for the issue of national bank circulation. And these had been absorbed and were firmly held by the national banks and commanded a fancy price. And basically, all they could use were the U.S. bonds, and that was pretty much it at this time, right? And so that commercial market hadn't really developed, which was pretty much one of his major points for the Federal Reserve kind of idea in general, right? And so the reason why this was kind of wanted, or the reason the banking system needed to be reformed in the first place, was the fact that this was during and kind of near the tail end of the Industrial Revolution, right? And so America was really starting to become the forefront of a lot of the world in terms of commerce and kind of that sort of thing in general, right? So we really started to become a major player. Whereas before it was kind of, we were only just developing in terms of kind of global trade in a way. And so that's one thing to kind of keep in mind is so basically he was saying America itself was outgrowing its monetary system, right? And so you had to basically reform the monetary system and all the banks and all of that in order to withstand that much more prominent role in the kind of global marketplace, right? And so basically he said it was the current system at that time was more provincial, to where it was basically like you had the different provinces around essentially, and then it would go from that. It was very localized, like we were saying earlier. And so basically there needed to be reform, else the system would just die essentially. It couldn't handle it, and he calls this explicitly fatal consequences of its inadequate structure, right? And then goes into basically what would happen for gold if a significant amount were to be withdrawn, whether it be for circulation or for foreign trade, right? Because at this time, gold was used as settlement between countries, right? And so you have to keep that in mind. And at the time with the current system, it was very much, with the banks being so individualized, if one bank does a bank acceptance or whatever with a foreign country for trade, then basically they were on the hook if gold had to be withdrawn. And so that specific bank would have to deal with their gold being withdrawn, and then they would have to get it from a different bank or borrow it from maybe another domestic bank. And so basically you had different, or you could have multiple, or we'll just, for simplicity of an example, we'll give two American banks basically having to fight each other for gold as reserves, right? And so basically you would have you'd have one who'd have to export their gold, for lack of a better term, and then basically they'd have to take it at the expense of another American bank. There was no kind of collective centralization of gold or reserves or anything to really function at that. So you had basically a weakening of multiple banks either way, instead of just having kind of a systemic kind of entire, I guess, sovereign identity in a way for kind of the whole banking reserve idea, right? And so he says, without a central organization, which by discounting or buying commercial paper, switching into commercial paper, could furnish additional currency or additional reserves, a heavy rise in deposits or a marked increase in the volume of circulation were bound automatically to tie up the banks, right? Basically, they couldn't fulfill that, right? And so, and he really wanted to transfer this over to commercial paper, because basically having the currency and the banking system of the United States essentially backed by its economy in a way, with the private sector, sort of, right? And so with no central institution, it provided relief. With no central institution to provide relief, nobody could strengthen his position save by attacking his neighbor. Kind of where I was going with the taking it gold in my specific example from another bank to kind of fulfill your own position is weakening a neighbor bank in a way. And so but one thing to keep in mind that I don't think a lot of people know or talk about is when you had these kind of central reserve cities and stuff, and you had problems with like the Panic of 1907 as an example, where there's kind of a bank run, right? And there's basically a liquidity freeze in terms of their reserves because they're so decentralized, they're not moving around, they kind of congeal in a way at one spot, like New York or something like that. So basically, within the confines of these kind of, with a particular city, they could start using something called clearinghouse certificates in settlement with one another, basically kind of creating their own kind of settlement token in a way, just a certificate saying that something is owed, right, between two clearinghouses or within a clearinghouse, and kind of keeping track of it that way. So when when liquidity does start to pick up and the system becomes more viscous again, then it can actually start settling those clearinghouse certificates and going on from there, right? And so there's that, and then I think that's pretty much all that's applicable at the moment. We'll kind of stop there and start talking about more of the foreign aspect in a different video, to where it's more like, how does this compare to the system itself in Europe? Is it a carbon copy? Where exactly is that? Because I've noticed there's a lot of different perspectives on that as well, right? And so it's just something to keep in mind. Oh, one thing I do want to say is kind of more of a cool fact, I guess, for the end of the video, is with these call loan markets and stuff for the stock market, at this time, that basically where all the reserves are being put, in terms of it being, I guess, the deepest and most liquid market at the time. At least that's what it seems. And so basically, when there wasn't enough liquidity, and when things won't move around, interest rates basically normally go up, but basically says that the interest charges on these call loans for the stock market would go from 50 to 100%, right? To bring on a contraction. And so basically that simple fact alone would basically cause a panic in a way, because who's going to pay 100% interest on something? Or would want to, I guess. But you also have to keep in mind that's relative to our current perspective now with our system and how it's working now. So that's also something completely different. But anyways, I'm going to leave that here. So I hope you guys have a good night, and I will see you on the next one.